10 years ago, imagine placing $10,000 worth of savings into Argentine pesos. You do nothing reckless. You don't gamble, you simply hold the cash. A decade passes. The number printed on the notes is still there, but measured by what that money can buy, roughly $114 remains. Nobody left the country, and yet almost all the value did. That is what makes this story different from a market crash. There is no single day to blame, no dramatic red candle, no obvious moment when the saver should have escaped. The damage accumulates quietly, between a salary payment and a supermarket, between one rent renewal and the next. Inflation does not need to empty an account. It changes what the account means. So saving becomes less about earning a return, and more about finding somewhere value can survive. Cross the border, and the same decision can produce the opposite result. The report compares a 10-year local deposit in Brazil with one in Argentina. After inflation, Brazil's CDI-linked deposit finishes with a real purchasing power score of 150. Argentina's Plazo Fico ends at 44. Same instinct, keep money in the familiar local system, but the result is more than 3 times apart. Geography did not merely change the currency. It changed the meaning of patience. People usually picture capital flight as an airport story. A wealthy family relocates, opens a foreign account, and moves everything behind them. But Latin America's larger financial exit often happens from home. The person stays, the savings move into dollars, the salary arrives through a digital wallet, a company routes supplier payments across a blockchain, a family holds investments through an offshore structure. Different tools, different income levels, one shared decision. Separate where life happens from where money lives. The popular version of this story begins with millionaires. The data points somewhere else. On Ethereum, the report says 72% of stablecoin transfers were below $1,000, up sharply from 2022. That does not prove every transfer belongs to a small saver. On-chain data cannot tell us everything about the person behind an address, but it does show that the growth story includes small tickets. Salaries, family support, emergency funds, and working cash moving through digital dollars. This is not just a Latin American curiosity. IMF researchers estimate that stablecoin flows in 2024 were largest relative to economic size in Latin America and the Caribbean, about 7.7% of regional GDP. In several major regional currency pairs, Chainalysis found stablecoins represented more than half of exchange purchases. Trading still matters, but these tokens increasingly provide a parallel route to the dollar, open after banking hours, and able to cross borders without the old correspondent bank chain. The interface makes this transformation look simple. Download an app, deposit pesos or reais, see a dollar balance, maybe receive a card. The experience feels familiar because it is designed to, but the screen does not tell you what you legally own. The balance might be a US bank deposit, offshore cash, a brokerage claim, or tokens held by a custodian. Similar interface, very different promise. The report audited 12 products marketed as ways to hold or use global dollars. Only 2 were structured as insured US bank deposits. 5 used stablecoins somewhere underneath. Across the full group, the money legally landed in 6 different places, from the United States and Panama, to the Cayman Islands, Singapore, Argentina, and the blockchain itself. None of those structures is automatically good or bad. The problem begins when a customer thinks they bought one promise, but actually received another. Moving out of a weak currency can reduce one danger while introducing others. A bank deposit depends on its institution and insurance regime. A brokerage balance depends on custody rules. A stablecoin depends on its issuer, reserves, redemption, network, and wallet security. An offshore structure adds legal and tax questions. This is not a recommendation for any one product. It is a demand for precision. What is the asset? Who owes it? What happens? And then, the report finds something that changes the entire picture. If digital dollars were mainly a hiding place from inflation, we would expect the money to arrive and sit still. It does not. In one measured cohort, more than 99% of withdrawn dollar volume moved onward within 30 days. The estimated half-life of those dollars was measured in days, not years. The new dollar system was behaving less like a vault and more like a railway station. Look at the ticket sizes, and the station becomes easier to recognize. In the report's lemon data for the first half of 2026, the average transfer or withdrawal was about $544 across more than 200,000 transfers. This is not a handful of fortunes changing jurisdiction. It looks like working money, invoices, subscriptions, inventory, suppliers, and salaries crossing borders. The exodus is operational. Money leaves the domestic system because the work already did. Mexico makes the scale visible. From June 2025 through May 2026, official remittances totaled roughly $63.2 billion. In May, the average transfer was $404. Alongside that enormous family money corridor, the report estimates peso's 2026 stablecoin corridor at an average of about $2.6 billion a month. These figures are not directly interchangeable. One measures remittances, the other platform flows. But placed side by side, they show two financial maps occupying the same border. At the other end of the income ladder, the instinct is familiar, but the machinery changes. Brazilian residents declared about $654.5 billion in assets abroad for 2024. Companies use structures in the Netherlands, the British Virgin Islands, Cayman, and the Bahamas. Individuals held foreign deposits, investments, and property. Stablecoins make movement accessible in small pieces. Offshore entities make ownership, succession, and investment portable at scale. They are not miniature versions of each other, just different doors out of the same room. Even here, the airport picture misleads. In the report's sample, 46 of 59 Latin American billionaires still lived in their home countries, yet almost a quarter of the group's wealth was positioned abroad. That is the distinction. Residence is not the same as financial location. The wealthy do not always leave. They spread out across a home, a foreign account, a holding company, a brokerage, and property in another jurisdiction. The migration happens inside the balance sheet. The result is not one clean offshore account. It is fragmentation. A private bank owns the legal structure. A brokerage owns investments. A digital bank owns daily cash and the card. A wallet moves salaries and supplier payments. Each institution sees one layer. The customer carries the complexity between them. Fees, passwords, tax documents, delays, and uncertainty about protection. The money found several homes. The financial life became a collection of rooms, with no hallway. What happens when the original pressure eases? Argentina offers a test. By mid-2026, inflation had fallen sharply from its crisis peak, and the gap between official and parallel dollar rates had nearly closed. Yet the financial infrastructure built during the crisis did not simply disappear. Trust recovers more slowly than an exchange rate. Payroll habits, foreign accounts, wallets, and tax structures have switching costs. Once people build an exit door, stability does not automatically persuade them to brick it up. That is why the next financial competition is larger than a battle for deposits. The winning institution has to connect the rooms, receive a salary, move money across borders, explain exactly where a dollar sits, invest it, spend it, document it, and protect access when something fails. A bank could build that bridge, so could a brokerage, a fintech, or an on-chain platform wrapped in regulated custody. But the winner cannot merely make the fragmentation invisible. It has to make the underlying promises legible. Convenience may bring the customer in. Trust will decide whether the money stays. Latin America's invisible exodus is not one transaction or one technology. It is a repeated decision to separate financial security from physical home. For some, that means a bank account. For others, a company, brokerage, or token moving through a public network. The question is not whether the balance carries a dollar sign. It is where the money legally lives, what protects it, and whether it should stay or keep moving. The people may remain. The financial map has already changed.